Learning Objective 12-3, understand and explain the differences between translation and remeasurement. Let me explain the problem very quickly. And this PowerPoint slide here is really perfect for understanding this. Let's say you're consolidating pepper with salt. You can see here's the consolidation worksheet. Pepper is denominated in apples, and salt is denominated in oranges. This is the ultimate mixed metaphor. Salt is denominated in oranges. You can't just add them together because they're using different currencies. It tells you on the side, pepper is in dollars and salt is in euros. You can't just consolidate them as is because salt is in euros. And you can't just add dollars and euros together as if they're the same thing. They're apples and oranges. So therefore, we're going to need a way to convert salt over from euros into US dollars. And there's basically two approaches to doing this, but they're not one or the other. It could be one, it could be the other, or it could be both. Translation is one approach, and translation would be from the foreign entity's functional currency into the parent's functional currency, US dollar. Remeasurement would be when the foreign entity's statements are not in its functional currency. What you would need to do is you would remeasure them into the functional currency. And then, if that functional currency is different from the US dollar, then you would need to translate it into US dollars. So, for example, let's take that division, that subsidiary in Florida and let's say the functional currency is the Venezuelan bolivar. Then the books might be kept in the bolivars, but the functional currency is the US dollar. Therefore, what you would need to do is remeasure it from bolivars into the functional currency of US dollars. I'll give you more examples of this in a moment. But let's just talk about what translation involves. Translation is most common. And again, translation is used if the foreign entity's financial statements are already denominated in their functional currency. And the conversion is very, very simple. You're going to use the current rate for all assets and liabilities. Also, revenues and expenses will be translated using the average rate. And then any translation adjustment, which would be the difference between basically a plug between debits and credits, is going to go to comprehensive income, or I should say other comprehensive income. And they call this the current rate method. Remeasurement, the idea of remeasurement is used when the books are not kept in the functional currency. So the idea of remeasurement is to convert the books over from whatever they're in into the functional currency. And to do that, you have to convert them as if you had been keeping them in the functional currency all along. And this is called the temporal method. So monetary balance sheet items, which are balance sheet items that have dollar or currency values connected to them, for example, cash, accounts receivable, accounts payable, notes payable, they all have a value to them that's explicitly stated. So we call these monetary assets and liabilities. These will be remeasured using the current rate, just like with translation. Non-monetary balance sheet items, like fixed assets, long-term investments, inventories, all these other kinds of assets and liabilities. I don't know how you would have a non-monetary liability. You could, I guess. There are ways. I'm not sure. Would be remeasured using historical rates. Historical rate would be the rate of the transaction that created the asset or the liability. So, for example, let's say you bought a couch 5 years ago. You would convert it over at the translation rate 5 years ago. Revenues and expenses are also remeasured using the average rate. And any imbalance doesn't go to other comprehensive income. The imbalance goes as a remeasurement gain or loss directly to income. So, for example, let's suppose the recording currency is the functional currency. Let's say it's the euro. So you have a subsidiary in Europe, and they keep their books in euros, and the functional currency is the euro. Then all you need to do is translate from the euro into the reporting currency, let's say the US dollar. Let's take a different situation here. Let's suppose that the recording currency is the British pound, but the functional currency is the euro. Then you would need to remeasure from the British pound into the euro. Actually, here, no, this case 2 is a little different. Let's say the functional currency is equal to the reporting currency. So let's say the functional currency is the US dollar, as is the reporting currency. And let's say the recording currency is the pound. Then you would need to remeasure from the recording currency into the functional currency, the US dollar. And again, remember that remeasurement is not translation. The third case is the case I was thinking about. Let's say that the functional currency is the euro, the recording currency is the British pound, and the reporting currency is the US dollar. Then you would first need to remeasure from the British pound into the euro, which is the functional currency, and then you would need to translate from the functional currency into the US dollar. So let's suppose the US company owns 100% of stock of Argentinian company. It's a subsidiary. Local currency in Argentina is the peso, which, by the way, I think is hyperinflationary. Subsidiary records and reports its financial statements in the peso. Scenario 1, the company pays its employees, buys its inventory, conducts most of its operations in pesos. So the functional currency is the peso. So what you would need to do is you need to translate the financial statements to US dollars. Scenario 2, the company's in Argentina, but it buys and sells most of its inventory in southern Brazil. And it pays most of its employees in the Brazilian currency, Brazilian reais. So its functional currency is the Brazilian real. So what you would need to do is, and let's say since it's in Argentina, they keep the books in pesos. It doesn't tell you that, but you got to know it. They keep their books in pesos. So when they prepare the financial statements, they prepare them in pesos. They would first need to remeasure the financial statements into real, and because that's the functional currency. And then they would need to translate them into US dollars. So first they would need to remeasure into real, and then they would need to translate them to US dollars. So very simple. If you have the recording currency, that's what you keep your books in, the functional currency. If the recording currency is the functional currency, but it's different from the parent, then you need to translate to US dollars. If the recording currency is different from the functional currency, then you need to remeasure to the functional currency. And if that's not US dollars, then you need to translate to US dollars. If it is US dollars, then you're done. So again, remeasurement and translation are not one or the other, like LIFO or FIFO. Either you're going to do your inventory with LIFO or use FIFO. It's not like that at all. You could have translation, you could have remeasurement, you could have both, where you need to remeasure and then translate. And there's this little chart in the book which is kind of nice that gives you examples of this. The recording currency, that's the currency of books, is US dollars. Functional currency is dollars. Reporting currency is dollars. You don't need to do anything. You can just consolidate. Let's say that you keep your books in pesos and the functional currency is pesos, but the parent is in US dollars. Then you need to translate from the functional currency of pesos into US dollars. Let's say that the books are kept in pounds, the functional currency is the dollar, and the reporting currency is the dollar. Then you need to remeasure from British pounds into US dollars. And here is the most complicated example, and this is the example you want to do because they'll pay you the most money to do this, is let's say the books are kept in Uruguay peso, the functional currency is the Brazilian real, and the reporting currency is the US dollars. That's what the parent uses. You would need to remeasure from the books, Uruguayan peso, into the Brazilian real, and then you would need to translate from the functional currency of the sub, the Brazilian real, into the functional currency of the parent, the US dollar.